Welcome to Catalyst. I'm Seana Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we're going to break down today's market action as the stock market rebounding falters after the S&P's worst sell-off this year.
Plus, we hone in on the AI trade as investors await Nvidia results, and also Microsoft reportedly rethinking its data center needs.
And we look at how companies and countries are bracing for President Trump's tariff threats as Mexico and Canada return to the negotiating table, and Apple looks to add 20,000 additional U.S. jobs.
Let's do a check-in on the markets here, just 30 minutes into the trading day. And we're seeing a bit of a reversal of some of that buying action that we saw at the open. We certainly had a buy the dip mentality, at least it initially looked like. Although if you were listening to Michael O'Rourke of Jones Trading right at the open as we were speaking with him, he said we still have a long way to go and he wouldn't be reading into too much of those early moves. And he certainly has proven to be right, at least for right now. You are looking at the S&P now in negative territory. The NASDAQ actually off about 0.6%. You have the Dow trading just above the flat line. And I think as we look ahead to the next several sessions, obviously Nvidia results are going to be a clear indicator to some extent, obviously a potential market moving scenario results here that we're going to be getting later on this week. But I also think the fact that the behavior that we've seen off the back of earnings is certainly something to note here, because overall earnings season has remained very strong, yet there are some of these worries and risks that do tend to linger and are lingering within the market when it comes to some of the policies out of Washington. And that's stifled some of that optimism, I think, so far.
And I feel like that's made it such a stock picker's market as well. When you think about the individual stocks leading to decreases of around 9%, but then you've got the overall index still moving to the upside and not tracking double-day digits of losses here. One thing I wanted to point out that we were talking about before the show, Seana, this idea that we've got nearly 90% of companies already reporting this quarter. Fourth quarter profit growth of 12.8%. Expectations were just at 7.3%. So you've got nearly double the expectations when it comes to profit growth. So huge potential catalyst when you think about that. But then on the flip side, you've also got a potential catalyst with the bond market in terms of yields coming in and what that means for equities moving forward, whether we've got a stagflationary risk or a risk of growth shocks moving forward here off the back of those Trump administration policies is certainly something that we're going to continue to monitor here.
All right, well, let's talk about one of the potential catalysts here for the markets coming up later this week, and that is Nvidia. Nvidia is set to report fourth quarter results later this week. Wall Street seeing Nvidia profiting from the global build out of AI infrastructure, but still, it's one of the most cheaply valued AI stocks right now. He broke it all down in his brief over the weekend, and following this very close to Yahoo Finance executive editor Brian Sozzi. Brian, how should we be looking at the valuation of Nvidia?
It looks cheap. I went to the Yahoo Finance comparison tool, one of my favorite pages on our platform, and you can dial up various companies and compare them to Nvidia. And one multiple, you can see that chart right there. I made it easy for y'all, but I encourage you to go to the page nonetheless because it's really fun to play around with. You can look at the P multiple, 4P multiple on Nvidia, and you can see it as one of the cheapest, relatively speaking, on a PE basis versus other top AI names. Of course, that's ARM Holdings, you have Marvell there, you have Broadcom, ticker symbol AVGO. And I put this question out to folks on our Morning Brief newsletter on Sunday, getting a lot of really interesting responses since then. I'm going to put out a piece later this afternoon sharing some of those responses, the clean ones and the good ones, I should say. And I think this is what you're seeing. One, you're not seeing estimates or earnings per share estimates really rise for Nvidia at all. If you go into the Nvidia ticker page on Yahoo Finance, click on the left rail and click on analysis, and you can see the EPS trends at the bottom of the page. EPS estimates on Nvidia have not risen over the last 30, 60, or 90 days for the current fiscal year. And in fact, they have declined about 2 cents over the past 60 days for Nvidia for 2026, which I found very interesting. So in order for it to get a higher P multiple, you normally have to get earnings estimates on the street to rise. Now, the other component for the price to earnings multiple, at least in my view, is sentiment. And you have concerns about DeepSeek, you have concerns about AMD making advances on the chip front, you have concerns about Amazon starting to make its own chips, you have Apple starting to make its own chips. So maybe the street is has priced in some worries on Nvidia. I think for this PE multiple to catch up relative to other AI trades, Nvidia is going to have to come out and really do two things: blow away earnings estimates for the quarter later this week, and then come out in the first quarter or the current quarter and blow away estimates for that as well.
Yeah, Brent, I've read about the volatility aspect also over the weekend
Loved your story.
when it comes to Nvidia and some of the behavior that we've been seeing in terms of the options market and maybe what that signals. And a lot of that has to do with maybe some of the growth concerns, how much of that has already been priced in. When you talk about the sell-off earlier this week when it comes to DeepSeek and maybe what that signals just in terms of how much of that has already been priced in and maybe that will just mitigate some of the volatility going forward. But again, when you write about Nvidia, just given the fact that it's been so important to the market, you do get a lot of feedback from our viewers just in terms of how we should be evaluating. And I think there is a lot of confusion out there just in terms of whether or not it is overpriced still, even though it is relatively cheap compared to some of those other AI trades.
Yeah, and I was thinking to ask you this, Brian. It seems like the market is both always happy and never happy because they're worried about Nvidia's valuation, but then when it comes down, well, is that a sign of a bearish signal for Nvidia that's not going to correct itself moving forward? So which one is it?
Well, let's be clear. If Nvidia comes out here and does not have good guidance and the earnings doesn't go well, Nvidia is still very, very owned by institutional managers all over the world. It's like their favorite company. So the broader market will be hurt. But look, I talked to Louis Navalier this morning on my opening bid podcast. He made a great point, and it's a very simple one. Nvidia is a monopoly. It's unstoppable. Now, I don't necessarily agree with Nvidia being a monopoly. There's AMD and there's other companies competing, but still, they are so far out in front of everyone. And while Nvidia's stock may trade at a discount relative to other AI names, the stock still trades at a relative premium to the S&P 500 at about 23 times. And that is a deserved premium. Nvidia over the next 2 years may grow earnings at about a 50% to 75% clip. So all in all, pretty good for Nvidia.
All right, well, Brian, we're about to talk to an Nvidia bear about this, so it's going to be a great conversation.
Good luck with that
really.
one. I'm going to stick around and watch this.
I know. You're going to be our biggest fan. All right, Brian Sozzi, our own executive editor. Thank you so much. Like I said, our next guest still bearish on Nvidia, even as that valuation is coming in. Joining us now to discuss, we've got David Bahnsen, the Bahnsen Group's CIO. David, great to have you here. So you just heard us talking about these PE expectations coming in for Nvidia here, but you remain bearish, even though that valuation is starting to look a little bit more attractive. Walk me through your base case.
The valuation is not looking more attractive. Everything that was just said is about forward estimates that are wildly speculative. The fact of the matter is it's 58 times on a trailing 12 basis, which is how people have always looked at earnings multiples, not on what they expect it will do, but on what it has done. And if you compare its earnings multiple to some of the other AI companies, let alone other Mag 7 and of course other S&P names, it's at an incredible premium. Now, I agree it's earned it. I agree it's deserved it and generated the order flow. But one of the key things that was said, that, and your editor pushed back on what Louis Navalier said, it's just simply untrue that it's a monopoly. Nobody in their right mind thinks Nvidia is a monopoly. There's tons of competition, but all the earnings multiple estimates are based on them never having competition. They're running at a 56% net margin where some competitors are at 12 and 15. I'm sorry, there's downward pressure coming on these margins and the PE does not yet reflect it. I would not time a negative guess. This thing could go up far more, but it's completely dependent on greater fool theory of just a $3.3 trillion market cap getting a bunch of more momentum. That's the thesis for the stock, and it could play out for a while.
Yeah, David, and I think that's the question also amongst investors, right? It might not be a monopoly, but the moat that they have created, the competitive advantage that they do have, I think a lot of bulls would say that then justifies the current valuation.
And again, the question is why the stock hasn't made a new high since July when the entire market's up substantially. And I think that the reason for this is that internal realization that the beauty of the technology story in America for years and years is that these margins come down over time. That you do not get to expand in infinity when there are real competitors. There's questions on order flow. There's questions on the utility of the very underlying thing being made. But the similarities, and I'm not saying identical, but similarities adjacent to what we saw with Juniper and Cisco in the late 1990s are absolutely uncanny. This is a phenomenal American success story that is substantially overpriced. And to grow right now 10%, which is not that big of a deal, you have to add a $300 billion market cap to what you already have. Basically add the size of a massive amount of the American economy just to get another 10%. That's the issue they're up against, is the law of large numbers.
Right, the growth expectations. And David, you make so many great points, but I wonder how you can kind of afford to be bearish big tech. And I want to pull up a chart here looking at, and I know you're going to have a great response to this, if I can have this chart here, looking at the S&P 500 tech names specifically versus income for the S&P 500 minus tech names. And you see a huge divergence in this chart where you're getting paid more to be in big tech. How do you afford to be out of it, even if your bearish stance makes sense to you?
Well, last year our dividend growth portfolio was up 23%, and the S&P was up 23%, and we owned 0 out of 7 S&P names. But in 2022, when the S&P was down 19 and big tech got walloped and NASDAQ down 30, we were up 6.5. So for a full market cycle, you can very much afford to be out of overvalued things. But there are periods where it can lag. I fully agree. This just isn't one of them. There's plenty of other things more attractive in the market than a 58 times stock that is already up 1,000% in a few years. I'm not talking about the trade of Nvidia of a couple years ago. We're talking about the trade of Nvidia now. And I think that at least on a risk reward basis, people have to realize that they're buying something very expensive, hoping it gets more expensive. The way to be out of it is exactly what, by the way, investors have done so far these 8 weeks. 4 out of 7 names are down, and while the S&P's up and value's up more. Rotation happens all the time in this market, and I will suggest 2025 is going to look a lot more like 22 than the last year. That's my expectation based on where we are in the market cycle.
So David, let me put this to you. Should investors ignore the forward P on Nvidia and the hundreds of billions of dollars being spent on AI infrastructure by the hyperscalers?
Yes, because that is so priced in, they don't have to ignore it. It's already in the stock. So the issue, by the way, the forward multiple of Nvidia is not 29 times.
What is it?
It's 29 times if everything comes up perfect.
Why wouldn't
every batter on your
Why wouldn't it come
baseball
on
team hits
perfect?
a home run every
This is
single
a company
time they're up
that
and back.
essentially owns the AI chip space and is powering the Gen AI movement. Why wouldn't it come on perfect? What has Nvidia done the past 2 years, David, that would suggest they're not going to come out here and beat big this week and raise up their estimates for the first quarter?
They've done nothing the last couple of years other than the foolishness.
Well, then why does everybody on the street own the stock?
The foolishness of an investment thesis that suggests that what has happened the last couple of years always repeats itself.
So we don't need AI chips from
Nvidia.
Nvidia.
Learned the lesson against that the hard way.
So realistically, Intel is more of a value than Nvidia.
No, Intel is not. It's simply a story about valuation of a multiple. It's a story about order flow combined with valuation. There's two dynamics to what places a stock. It's both the fundamentals of the business combined with what you're paying for that story. People who ignore the latter have lost their shirts for years and years. Many of them learn it the hard way. Intel's story is not valuation. The reason it's broken is fundamentals.
So what you're saying essentially is that AI, what Nvidia is putting out, is not important to the world. And then you should wait, for the stock to correct 50% before you get an Nvidia?
I didn't say it's not important to the world. I said it's already priced in.
At 29 times forward earnings, even at 58 times. Why
it is not
expensive
29
to you?
times earnings. That
What
is
would make
based
Nvidia
on
attractive
a
to you?
sustenance of a 58% net margin and an 80% gross margin.
But who else is
So
near
good luck with
Nvidia?
that.
Who else is doing what Nvidia is doing? They're expanding
Nobody.
margins.
That's why nobody else is at $3.3 trillion market cap.
Well, then what do you think about Apple then?
I think that Apple is suffering in the same story. Why Apple's down a little bit this year too, because it's a huge success story that the good news is priced in. And if people think that Apple's next 10 years is going to go the same way as the last 10 years, then good luck to them. I would love to see that compounding of a $1,500 phone the way the last 10 years did. Nobody's saying anything negative about Nvidia or Apple over the past. Investors are making decisions today about the future.
10 years ago, Apple was expensive too. Look at it now.
No, it wasn't. It was 16 times. You're wrong. It was half the multiple it is now. Look it up.
David, I want to jump in here just to give our audience some actionable insights from your portfolio performance, because you talked about the outperformance of your portfolio despite the fact that you are not in some of those big tech names. Can you talk me through what your rubric for success of those non-tech names looks like and how you are thinking strategically about those picks? Any individual names you want to throw out as well?
Well, I think that in the last couple of years, there was an incredible opportunity in financials, and we just happened to do extremely well with dividend growers in the financial sector and then the midstream energy sector. I think midstream energy is still at extremely reasonable valuation based on yield spreads and all historical metrics. So I would heartily recommend continuing in the midstream energy sector. Upstream energy is a little less attractive, but I also believe that the financial side has plenty of value. But the things that lagged are now things that are catching up, which is some of the names in healthcare and pharma, consumer staples. These are great dividend growers. A lot of it depends on how severe the rotation is from growth to value type trend. We don't like to play it on a top-down basis, though. We're bottom-up stock pickers, which is why when you look at a fundamentally wonderful story of huge performance from some of these names like Microsoft, what they've done in the cloud, Nvidia with AI chips, Apple with a telephone. I mean, these are huge success stories, but we have to combine them with the forward free cash flow generation that's not already in the stock. And I think there's just a lot of great opportunity. And we measure this by one of the reasons we did so well with Broadcom. Broadcom is not the type of name we normally would buy, but their AI order flow became a significant competitor for Nvidia. And by the way, they were a huge dividend grower. We're at about 25% yield on cost on Broadcom, even though it's now down to a 1% yield. So I think you have to look at free cash flow right now, and I think you have to look at valuation. And I recognize a lot of people don't think you have to look at valuation. The good times are supposed to roll forever. History has just not been kind to that thinking.
All right, David Bonson, we always appreciate you playing along. Thanks so much for coming on here with us, Yahoo Finance. We look forward to continuing the conversation.
Thank you.
Coming up, we're going to be breaking down the debt ceiling's impact on the bond market. We've got that and much more, some of the biggest drivers of the market here as of late. Again, just about 45 minutes into the U.S. trading day, you are looking at stocks giving up some of their earlier gains here this morning. You have the NASDAQ under a decent amount of pressure here. We'll be right back.
Could the bond market be pricing in a growth slowdown? The 10-year yield has declined for 6 consecutive weeks and is currently trading at its lowest level this year after peaking just under 4.8%. Joining us in studio to discuss what's next for the market, we've got Tom Tzitzouris, Strategas Securities Head of Fixed Income Research. We also have Paul Eitelman, Russell Investments Chief Investment Strategist. Thank you guys for being here. Tom, I want to go to you first on these 6 weeks of consecutive moves to the downsides in yields, the longest stretch since 2019. What do you think the bond market is trying to tell us about growth versus any stagflation concerns?
Well, I think the bond market is trying to tell us that the U.S. economy temporarily is in a seasonal growth slowdown. That seems to be happening about every February and March. Credit card debt builds up, households pull back. We're in that seasonal slowdown now. We got some consumer sentiment numbers last week, which further indicated that consumer optimism is fading a bit. So the bond market's telling us that we're in a seasonal slowdown. But another thing that the bond market is telling us is that the fears of a trade war were vastly overblown earlier this year and late last year. And as reality is setting in, there's going to be eventually tariffs somewhere along the way, but it's not likely to be a full-blown trade war and one that has a prolonged impact on inflation. So you're seeing some of those fears recede. And I think the other factor that you're seeing right now, as of today, it's going to start to change in a few days as liquidity starts coming in. But another factor that you're seeing is that the market is also recognizing that there's not going to be any near-term deviation between the current Treasury and the prior Treasury in terms of their debt issuance schedule, which is also helping to ease some fears in the back end of the curve and push longer-term yields lower.
Paul, how does that compare to how the equity side of the equation has been looking at things?
Well, I think equities have a difficult setup here. Starting points in terms of valuations are pretty high. Policy uncertainty is pretty high, but I think it's important to focus on fundamentals too. And we're a good bit of the way through the fourth quarter earnings season now, and it's been very strong in the aggregate. The S&P 500 index is tracking 16% earnings growth at this stage. That's well ahead of consensus expectations going into the reporting season. And I think on top of that, we're starting to see earnings growth broaden out now. It's not just the Magnificent Seven stocks generating earnings growth. It's the 493. We're seeing financials back to positive earnings growth, and that broadening out from a fundamental perspective, I think is a positive for equities for sort of the medium-term perspective.
What does that tell you about the Mag 7 names, though? Does that also, on the flip side, present a risk to some of those big tech names if the broadening goes too far?
I mean, there's always a risk. Those valuations are high, and the names have rallied very strongly, and so there's always the possibilities of volatility and pullback in those names. I think the more favorable scenario for equity markets going forward is that those names kind of plateau and generate more modest returns, and the rest of the market starts to catch up and outperform, and I think that's our central expectation for 2025.
Tom, when it comes to the likely action that we're going to see within the bond market, I guess how much of that risk has already been priced, and how should we be looking at the level as to where yields are today?
How much of the economic risk is priced in of, say, an economic slowdown? Not much. So realistically, if we were to see any sort of recession, even a very shallow one, we'll call it a negative 0.5% to 1% GDP for 2 quarters, unemployment goes to 5%, you're probably looking at the Fed funds rate going down close to 3%. Which would suggest that the entire Treasury curve from 0 to 10 years is between 3 to 3.5%. So we're not pricing in any sort of even shallow slowdown in the U.S. economy.
It's interesting in the context of the Trump administration and Treasury Secretary Scott Bessent saying that if the moves we've seen in yields just continue, they'll get exactly what they want for the 10-year. Do you see the moves in the 10-year as a success story for this administration right now?
Well, as of right now, yes, because it could have been a lot worse. We'll gauge success 3 years from now when the Treasury has raised its coupon auctions and has not only financed future deficits, but has begun to scoop and toss those enormous amounts of Treasury bills that the prior Treasury pushed into the market ahead of the elections to kind of flatten the curve. If they can refinance those successfully without pushing 10s, forget about the 5%. If they can do it without pushing 10s to 6%, we'll consider it a success. There's a huge hurdle ahead for the current Treasury from a crisis that is not of their making. Right. And we'll judge success 3 years from now.
Paul, give us some insight just from the active manager side of things. I think investors are struggling with what to do at this point with their portfolio, given the uncertainty, given some of the headwinds and challenges that are out there right now. What would be your top advice that you're sharing?
Well, I think our money manager is looking for quality companies at a reasonable price right now, and they're trying to take on board all of this policy uncertainty and find where there's opportunities and good skew in the market. And what we're hearing is financials as a sort of standout sector and industry. One of the things that I think is quite clear right now at this stage with the new administration is that they are deregulating very quickly, particularly with the Consumer Financial Protection Bureau and other segments of the market. I think there's an expectation that we could have more M&A activity in 2025 that came through from some of the bank's results and guidance earlier in this reporting season. And so that's an area of the market that has underperformed, is trading cheaper, and could benefit from both deregulation of the financial sector and more M&A activity from the sort of capital market side.
All right, Paul and Tom, we got to leave it there. Thank you so much. Appreciate it. We're going to have all your markets action ahead, so stick around for more. You're watching Catalysts.
Microsoft potentially canceling some leases for U.S. data centers. There was a new note out from analysts at TD Cowen raising those concerns this morning. The report raising concerns on whether Microsoft is in an oversupply position. Of course, the big takeaway from this is what that demand picture potentially looks like here going forward. If in fact these channel checks do prove to be true, and we are seeing Microsoft move back on some of these lease cancellations here over the next several quarters or several years. Again, I think overall this just calls into question the amount of spending going on in AI right now when it comes to big tech. Maybe explains some of the pressure that we are seeing across the board when it comes to some of those larger tech giants here today. But again, some concerns about oversupply, concerns about demand here at this juncture because of the channel checks that were published in this TD Cowen report. Of course, could potentially be a focus here for investors. We asked Gil Loria about it from D.A. Davidson earlier on in the show, and he was saying it's a little bit too early to tell. But again, it's more we have to glean from the bigger picture. Nvidia will give us a good idea of what that demand essentially looks like here on Wednesday after the bell when they do report. But again, it is a market moving report that we're seeing this this morning with shares off just about 2%.
It's interesting in the context of this complete and utter focus on exactly how much AI CapEx there is going to be. We did have Microsoft reiterating their plans for that $80 billion in CapEx, but they did not necessarily confirm or deny this note from this analyst over at TD Cowen on Microsoft canceling these leases from data centers. So as you said, Sean, I think the most important thing is that supply and demand duality here. There was this question for a lot of the big tech firms about whether or not they had an undersupply that was not allowing them to take advantage of all the demand that they had. And now so quickly it can just turn and lead to the opposite end of things where you have a question about whether or not there is going to be an issue on the other side when it comes to supply. And interesting in the context, too, again, of that huge focus on AI CapEx. And if Microsoft is continuing on that AI CapEx, is that enough if they're just transitioning where they allocate capital here instead of kind of any overturning of their data center?
Yeah, exactly. And I also think it's important to point out that within this report, they were quick to couch that they don't know exactly why this could potentially be occurring. They do bring up the question about the oversupply position. Obviously, that's one that we've discussed here. But again, there are lots of questions if this were in fact to be happening, just exactly what is the catalyst and why we are seeing that, whether or not it's indicative of something more broader.
Yeah, absolutely. Well, we're going to stick with Microsoft and what changes to AI data center plans could mean for the AI trade. Joining us now, we've got John Belton, Gabelli Funds Portfolio Manager and Managing Director for Growth Portfolios. John, great to have you here. So just want to get your initial reaction here to this feedback from this analyst, specifically when it comes to the rollback of these data centers. What do you think is happening there?
Well, I would first say I would strongly advise against, over extrapolating these channel checks. Not to take anything away from this analyst, and I'm sure that the things he's hearing are what he's hearing, but I think these are the types of checks that can be very, confusing to take out of context, or it's very important to take these in context. So are these leases that are being canceled that are net decremental to Microsoft's spending plans? Doesn't seem so based on what the company said this morning. They say there's absolutely no change in their data center spending plans. More than that, are these net decremental to industry-wide CapEx spend? Very unlikely. I think any change you're going to see in Microsoft's nearer-term CapEx spending are probably related to the change in relationship with OpenAI, meaning lower Microsoft CapEx spend would simply be higher Oracle CapEx spend. So I think those are the two first main points. And yeah, bigger picture, Microsoft said very clearly less than a month ago when they reported December quarter earnings that they're going to be supply constrained on the Azure AI services side of the business for at least the next couple quarters. So this is not a near-term impact to number. I think today's stock market reaction or response, sort of a continuation of a lot of the rotation we've been seeing the last couple days.
John, do you think results out from Nvidia are going to help alleviate some of these concerns?
Well, I think Nvidia should have pretty strong numbers. I think that's always healthy for the market to, go back to basics, go back to fundamentals, go back to numbers. I think Nvidia's report should provide the AI space, a sigh of relief that things really haven't changed for the worse. In fact, I think a lot of the fundamentals supporting the industry remain very much intact. But again, I think a lot of the, what's been happening in the NASDAQ the last couple of days, it's more market rotation. It's unwinding a lot of the performance, the outperformance to start the year, kind of resetting to reflect what is sort of a shakier macroeconomic and geopolitical backdrop.
And on the point of this note from TD Cowen, the real question it sort of boils down to is Microsoft going to have an oversupply problem? Do you see any evidence of that?
Definitely not near term. I think I have very strong conviction that is not going to be the case near term. All we heard over the last earnings cycle from the hyperscale companies, really from all technology companies, is the AI investment cycle is certainly continuing over the next year at least. I think there's a lot of optimism around some of the new AI services and applications that are coming to market this year. Very high conviction that data center CapEx, data center spending plans, especially in the near term, are not changing. And again, Microsoft is out this morning saying data center strategy has not changed. So I think these are channel checks that were probably taken way out of context. And that's not to say that there isn't a nugget of truth in them. I just think it's very hard to believe that a company of Microsoft's size for something that's as sort of long lead time as data center planning would have radically shifted its strategy in such a short period of time.
John, more broadly speaking, how are you looking at the relative underperformance or maybe muted performance that we've seen from many of these tech giants since the start of the year? Is there a catalyst that's on the horizon that's going to change all that if it's not Nvidia's results?
Well, I think I'd like to look at things on a longer term basis. So I think, sure, over the last week, the Mag 7 has come under pressure. I think year to date now, only one of the Mag 7 is positive. So yeah, tough start to the year. But what about over the last 12 months, over the last 24 months, over the last 60 months, or over the last 5 years? These stocks have been workhorses for any portfolio that's owned them. I don't necessarily see why that can't continue to be the case. I think valuations across this group are still pretty reasonable. Fundamentals, most importantly, are very strong across this group, Microsoft included. So, in terms of what catalyst can change things, that's, I think, very, very difficult to pin down. And trying to call the market near term in an environment like this is going to be tough. But I'm comfortable sticking with a lot of these names through this volatility.
John, is there one better position than the other of the group?
No, I just think they're all kind of case by case, all have different drivers, all have different dynamics. I still think Meta is a very interestingly positioned company. I think that's a business trading at a pretty reasonable valuation with, it's not hard to see, how they can unlock some pretty large untapped revenue pools in the future. I think they still have quite a bit of margin upside as well. So I think Meta is one that I continue to really like, and that one has hung in better than the rest of the group year to date. So.
All right, John, we're going to leave it there. Thank you so much for joining us. Appreciate it.
Thank you.
We'll have all your markets action ahead, so stick around for more. You're watching Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session. It can all be done at Yahoo Finance's trending tickers page. First up, let's take a look at Strategy. It's formerly known as MicroStrategy. Looking at some losses here this morning, off nearly 5%. The company announcing that it's buying more than 20,000 Bitcoin worth nearly $2 billion. Now, the world's largest corporate Bitcoin holder, now nearing 500,000 Bitcoin. This is obviously nothing new from the playbook here of Michael Saylor. They've been buying Bitcoin nearly every single week dating back to October. Certainly they have been able to profit off some of that bullish momentum surrounding crypto ever since they started buying into this here as a hedge against inflation. You have seen crypto, Bitcoin specifically, rise just about 700%. So clearly benefiting off of that. We are seeing a bit of a give back here this morning, though. Shares off just about 5%. But again, sticking to the playbook that has, I guess you could say, has worked out for them.
It's so interesting when you take a look at the longer dated charts here, too, because over the past year, they're up 257%. Year to date, down 5%. So all of that buying and momentum that we saw lifting this stock to the upside following the election, potentially coming off of its steam just a little bit here. And I find that interesting in the context of a story you've already covered today, Seana, about Robinhood and the SEC leaving its investigation of Robinhood behind. That follows the SEC doing the same thing with Coinbase. So I would have thought that would have led to a lift in some of these Bitcoin adjacent stocks, but looks like this morning we are seeing the opposite happening with MicroStrategy off about 4.5%. Next up, Starbucks eliminating about 7% of corporate jobs this week. CEO Brian Niccol looks to deliver on his turnaround plan. Yahoo Finance's Brooke DePalma joining us now with more details on the layoffs. Brooke, what can you tell us?
Good morning. In a memo this morning from Brian Niccol to employees, he did inform the company as well as investors that there is going to be a layoff of 1,100 people beginning this week, and they will be notified by Tuesday, February 25th, tomorrow. Now, he said in this this memo to employees that this really is intended to simplify the company's structure, operate more efficiently, increase accountability, reduce complexity, and drive better integration, all part of that back to Starbucks plan that is his key strategy as he really takes the helm now since September, with a focus on core coffee products, better pricing, and faster service. Now, beyond this layoffs that's going to impact roughly 7% of its workforce, we also know that the company is asking vice president level and higher to return to the office at least 3 days a week, either in Seattle for U.S. employees or in Toronto for Canadian employees. Also important to note here, hiring for future employees, that's also going to be impacted. They will be expected to report to either Seattle or Toronto, and if they are, of course, hired and they're not part of that remote hybrid workforce, which will remain intact, just that they have to come in these cities.
Yeah, and Brooke, I think it also just illustrates just a tough macro environment that so many of these companies are up against right now. You also covered Domino's. They were out this morning, and a little bit of a different story there, but shares under a bit of pressure following some of those weaker than expected results.
Yeah, shares for Domino's fell as much as 6% this morning, and that was largely because of this ongoing pressure hitting the consumer, and also as well as this low-income consumer pulling back from their delivery service. So if you take a closer look at those numbers, earnings and revenue, they both missed Wall Street's high expectations. Food inflation did drive that revenue number higher, and they do expect that in 2025 that food basket is going to be up low single digits. They expect increases in the first half, then the second half, primarily driven by, interestingly enough, cheese prices. So keep a lookout for that. Now, their U.S. business did underperform. They noted that in-store pickups increased roughly 3%, but deliveries fell 1.4%. They did once again allude that to an impact on continued macro and competitive pressures that put pressure on that low-income consumer. Two other things to look out for here. Domino's executives touted on an earnings call with investors this morning that there still will be two forms of innovation. They kept closed lips on what exactly those innovations will be. Wall Street hoping that it's that stuffed crust pizza that has investors excited. Also, lots of investors looking out for that DoorDash partnership after they saw an increase of nearly 3% from Uber Eats. But they said that DoorDash partnership is going to be pushed out and won't happen just yet. So keep a lookout for that one.
All right, Brooke, thank you so much. Appreciate it. We'll have all your markets action ahead, so stay tuned for more. You're watching Catalysts.
Several government agencies telling federal workers to ignore an email from DOGE that came out over the weekend demanding that they explain their work over the past week. Now on X, what you're looking at here, Elon Musk saying that failing to respond to this request, quote, would be taken as a resignation. Here with more on what this latest internal pushback means for DOGE's cost-cutting campaign is Washington correspondent Ben Werschel. Ben, it's great to have you on. How should we read this? The one side, you might have Elon Musk just kind of doing it for some of the drama. And then you have President Trump over the weekend reiterating the fact that he wants Musk to get even more aggressive than he's been.
For sure, yeah. And then the third element here is that the email that went out on Saturday evening didn't say anything about firings. Musk tweeted what you put up on the screen there, but what the email actually said was just give us this by the end of Monday, and didn't talk at all about firings. And what I think is also leading to a lot of confusion here in Washington about this is that a lot of Trump's closest allies, their immediate response to this was to say, ignore this. Kash Patel was confirmed as the FBI director just a couple days ago, and the first major headline now that he's in office is him telling his workers, you don't have to respond to this. Similarly, at the department, the overseer of national intelligence, as well as the Department of Defense. So it's kind of led to this kind of, we don't really know exactly what this is. There's a kind of, but the overall mood music here for certain is that the question here, I think, among federal workers is kind of how far Musk is going to be able to go with this. There's no expectation that this is going to lead to mass firings at 12:01, but Musk is clearly kind of entering a new phase here as he goes from low-hanging fruit contracts that he can just kind of cancel unilaterally, probationary workers who enjoy a lot less legal protections, to longer-term government workers who have more protections, and I think are clearly in the target here. So we have this deadline of tonight. There's a lot of unclarity on what it is, and whether or not this feels itself out in the next couple of days. It's clearly going into these workers' files. That's the sense I get, and then they're going to be, as Musk gets to their department, do they respond to this or not becomes a question.
Well, all of this cost-cutting, Ben, also comes ahead of House Republicans set to vote on that $4.5 trillion tax cut and reconciliation bill this week. What do you expect from that?
For sure, yeah. This is the make or break kind of first step for taxes this week. Mike Johnson and the House Ways and Means Chairman Jason Smith have really pushed this kind of idea of one big, beautiful bill, and Donald Trump has endorsed it. So, but the question is, he has a lot of problems with this. Here's some quick numbers for you. This is $1.5 trillion in spending cuts, $4.5 trillion in tax cuts, which equals about $3 trillion in possible red ink. Johnson sort of has problems on all sides of this. A lot of these cuts, especially ones to Medicare, are ones lawmakers got a whole earful about last week when they were home in their district. $3 trillion in new red ink is a big problem for real fiscal hawks, and then that doesn't even get to taxes, which $4.5 trillion, believe it or not, is low amongst some of what they want. I've calculated Trump's various tax promises. He's made somewhere in the neighborhood of 16 to 17 different tax promises, both this year and last year, if you count the campaign. And $4.5 trillion could not even cover the first one of that, which is fully extending his Tax Cuts and Jobs Act from 2017. So this, believe it or not, this is going to be a really hard week to kind of get this through and see if we're going to get a tax bill now. But it could actually be the easy part, because the actual tax negotiations, whenever they come, will be even tougher. And what we will learn this week is kind of the shape of the tax bill, but we'll also get a sense of what the government shutdown fight, which, believe it or not, is in 18 days. The government could shut down in 18 days, as well as the debt ceiling, which is also entwined in this in a lot of ways.
All right, Ben, got to leave it there. Thank you so much.
Sure thing.
Mexico and Canada have reportedly intensified discussions this week in an effort to avoid tariffs as that March 4th deadline looms. This comes as Canada's 6 big banks are expected to build reserves to offset potential tariffs, according to Reuters. We got Heidi Kribo-Redeker, a senior fellow at the Council on Foreign Relations. She also served in the Obama administration as the State Department's chief economist. Here to discuss. Heidi, let's start on Canada building these reserves. Help walk our audience through the potential economic impact of a move like that, and do you foresee other countries following suit?
So, I mean, as you mentioned, this sort of the clock is ticking on a number of fronts. Mexico and Canada, obviously, coming up in a matter of the next week, and you have companies that are front loading purchases and trying to make sure that they can actually be prepared in case these actually that Trump decides to actually impose the 25% tariffs on both Mexico and Canada. But the negotiation, you have to remember, this is about leverage and leverage for illegal immigration and for stemming the flow of fentanyl. So it's I think Canada and Mexico can do quite a bit on the non-tariff side, on the to actually make sure that they do not have these tariffs actually go into effect on the March 4th.
Heidi, there was a recent Bain survey, and they spoke to COOs, top executives, asking them just about the potential impact of these tariffs on their business. And they found that 40% of those COOs and top executives are anticipating double-digit increases to input costs due to some of the tariffs that have been threatened from the White House. I guess, what is your assessment of some of those broader economic implications and ultimately how this could potentially slow some of the growth that we are seeing in the U.S. economy?
So I fall into the camp that thinks that this is actually very much going to be inflationary and could hit growth. I don't think that we have an administration that fully appreciates the supply chain shock that would come on imposing the 25% tariffs, particularly on Canada and Mexico. So companies should be worried about this, but it's also going to be one of those moving targets. Right now, we really only have the 10% across the board on China. We have, an April 1st deadline coming up on reciprocal tariffs, which I think is actually potentially extremely disruptive because no one really understands how the Commerce and USTR are going to calculate, including VAT and currency and potentially digital services taxes, and go product by product. I think this is for a customs officer, this is a nightmare, and in trying to actually figure out who should be charged what. And again, all of the payments, you have to keep reminding yourself, it's the U.S. customer that is paying the tariff, whether it's for intermediate products or for end products.
So then, Heidi, what's the ultimate fallout just in terms of U.S. competitiveness, what it means for innovation here in the U.S.?
So I think, we've seen over the past 4 years, actually, post-COVID, many companies around the world taking a China plus one strategy because they wanted to make sure that they could insulate themselves from shocks coming out of China. I think we might see sort of in a sort of 30,000 foot companies looking to do a U.S. plus one strategy right now. The U.S. is obviously a market that is, you have to be in the U.S., but more and more countries actually have China as their number one trading partner. And if you're going to have your best friends, if you're sitting in Canada and your closest ally to the south is actually threatening you with tariffs, you're going to look at ways to diversify to cut your vulnerability. And I think that is overall long-term strategically negative for the United States.
Heidi, I want to switch gears a little bit and ask you about this email that Elon Musk sent out to federal employees last week. As someone who worked at the State Department yourself, how are you digesting the idea of an email like that? When you were at the State Department, what would you have done if you got an email asking you to outline the work that you'd done in the prior week?
So I think that the response of the State Department was appropriate, and same thing with the FBI, with the Department of Defense. Really, this is something where it's not. I couldn't have disclosed, a lot of the things that I was working on because they were confidential and wouldn't be limited to 5 bullet points. So I think it is good that there is some pushback from the agencies themselves because this is obviously unprecedented and think what you might about DOGE and their objectives, but the way that they're actually implementing this is really it's really questionable.
All right, Heidi, always great to have you. Thanks so much for joining us here with your insight. Heidi Kribo, Rediker.
Thank you so much.
Well, coming up next, it's dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you tomorrow.